right, good evening, everybody. Thank you for joining us. Today we have a special guest, Seth. Seth, welcome.
Hey, thanks for having me.
Thank you. So, Seth, can you tell us about your journey and your background?
Sure. So I got started in real estate as a real estate agent. So what I was doing was I was refereeing hockey professionally. So I was in the US working a whole bunch of different hockey leagues and realized I needed a real job. So I got my real estate license and sold houses for a while. And at some point, I realized that the income was coming in, but it was going out just as fast. I had a house I was living in all by myself. I had the nice car, but I wasn't really building anything. And that's when I realized I needed to start acquiring real estate and start building a real estate portfolio. So I started off in single family homes. And then I realized that I could not scale to the size I wanted to scale with single families. So that's when I made the conscious decision to switch gears and concentrate on the multifamily side.
Perfect. How did you know we have to switch on multifamily? Did you take any course or?
Yeah, so I think anybody who invests in single family homes will know that the cash flow yield isn't as strong. So, if you have a duplex and one tenant moves out, there goes 50% of your revenue. Even with the fourplex, what business can absorb a 25% decrease in revenue overnight? Well, it's happened to some businesses with coronavirus, and a lot of businesses are in trouble. So the cash flow yield was a problem for me. And then management becomes a problem because you're dealing with all sorts of different properties, all like single family homes or duplexes, and residential property management is very expensive. Most people pay 8 to 12% for management for these properties. So that's going to cut into that already lower cash flow yield. So if you're looking to scale that portfolio, I just saw some problems there. And then I guess the biggest thing would be financing. If we have any American viewers, you can probably tell my Canadian accent right now. So I live just outside of Toronto, and the Toronto market is a very hot market. And even though I was making what most people would consider really good money, I no longer fit within the bank's boxes. So banks have a box they want everybody to fit in. And as real estate investors, at some point, we will all find ourselves outside of that box where we no longer fit the debt service ratios they're looking for. And once you hit that point, it is so challenging to get conventional debt on a property and take advantage of all the low interest rates. So I found myself knowing I needed to scale. I knew I needed to go bigger, but the single family homes, it was not the right vehicle. I knew real estate was the place, but I was choosing the wrong car to drive in. So what I did was I looked at all the different options. I didn't know it. At first, I thought apartment buildings were just for rich people. I didn't realize that normal people can start buying apartment buildings. I thought it was big companies and like insurance companies that would buy these. So I looked at all my options. I looked at retail, industrial, office, and multifamily. And I looked at how these assets performed over the full market cycle. So as we all know, real estate's a cyclical type of market. So we have our peak, and then we have a slump phase, then we have the recovery, and it repeats time and time again every 8 to 12 years. I found that multifamily was the most stable in downturns and experienced most of the time the fastest uptick once the market started to recover. So as I was looking for an asset to invest in, I think rule number one of any investing is you want to preserve your capital. You don't want to lose your money because if you lose your initial investment, you're done. The game's over. But if you can preserve that capital, you can live to fight another day. So that was extremely important to me. So multifamily you were able to scale. The financing side was a lot better because instead of looking at you, the borrower first, like they do with houses, on the commercial side, they look at the property first. I was able to bring in other investors into a property. So I was able to scale bigger. The cash flow was stronger. And management, these larger properties have full-time staff. So you have full-time maintenance, full-time leasing agents. So, and I saw all these benefits there that I wasn't finding with single family homes. So that's why that's a very long-winded answer as to why I decided to go with multifamily.
Perfect. So how can you like what how can like somebody who is starting out who wants to go from single family to multifamily, what will you suggest?
Yeah, well, first of all, before we even talk about assets, I think the most important thing is just to have a vision for how you want your life to be in 10 years. That is probably the most important thing. The reason why I say that is, when I started acquiring properties, I didn't know where I wanted to end up. So I was buying these properties, but it wasn't getting me closer to anything. I was just buying properties willy-nilly. If you know where you want to be, you will make decisions. So for example, on my podcast, I had a guy on, and his goal, his dream in life is to run his entire real estate portfolio from a pub in Ireland. He lives in the States, but he wants to retire and move to Ireland in Dublin and run his portfolio every day from the pub. So he will make decisions differently than I would because he's going towards his goal. So how he structures his investment, how he hires property management, every decision is tailor-made to putting him in a pub in Ireland. So I think before we even talk about getting started, it's important to have that vision because that will impact everything else you do. And once we've answered that question, then we can start talking about, okay, well, if I want to be running my portfolio over my cell phone because I want to travel the world, now I can start looking at property management and figuring out the best asset that I can acquire. But yeah, to answer your question on how we can get started in multifamily, if somebody is investing in single family homes, they have a good grasp at the overall strategy. It's very similar to we had a question pop up from Victor.
Yeah.
When you invest, do you have a minimum amount of doors per building before you jump in? Are you talking about, are you looking for a minimum number of doors in a property or a minimum number of residential properties before you jump in? Victor, if you can just clarify that. Oh, okay. Well, as we wait for, residential, yes. Everybody has their own opinion. I'll give you my opinion, and some people may agree or disagree. If I could go back in time and sit down with myself before I bought my first residential property, I would tell myself, don't do it and just jump right into commercial. The reason is, a lot of people think that you have to start with residential properties to get started, to get your feet wet. That's not the case. I think there's a very good argument in that, if you go straight to a commercial property, you can take advantage of professional management right away. And you can really learn a lot from the professionals helping you run your deal. Whereas with residential, when buying your first house, a lot of people self-manage. They'll make a whole bunch of mistakes, which is good in a way. But rather than learning from making all the mistakes on your own, you can actually just watch a professional in action and learn the same amount in a whole lot less time. So I think, I have friends who built a residential portfolio, then they sold it and moved that money into multifamily. So I don't think there's a minimum number of doors that you should be at before you make the jump into commercial real estate. I think it's more, how does it fit with your goals and where you want to go? Some people have the dream of owning 5 to 10 houses and they just want to work their full-time job and then retire on those houses. If that's what you want to do it. But if your goal is to move into more of a stronger cash flow position and bring in other people on a deal and really take advantage of commercial real estate. If you're at 2 houses or 4 or 6, it doesn't matter. If that's going to take you closer, I would say make the jump now. Yeah, so Victor, I hope that helps. I wouldn't say there's a minimum that you need at all.
How about the down payment?
Yes, so commercial lending is different. And I think it's important to differentiate the size of property we're working with. So when we talk about multifamily, some people mean, you know, a 6-plex or a 10-plex or a 15-unit building. Other people will mean commercial multifamily. So that could be a 50-unit or a 75-unit or a 100 or 200-unit property. Down payments and how that's structured will change depending on what size we're playing in. So if we're in a smaller 6-plex, for example, a lender may need 25% or 30% down to finance that conventionally. With the larger property, so let's say it's a 150-unit property, we may need 25% down or 20% down, but then we can structure in interest-only payments, which we don't really get in the residential space. So when we have these large properties, it's very competitive for lenders because they want to. The thing I found is with houses, you have to fight with the bank to give you a mortgage once you own a bunch of property. When you get into these larger properties, the banks actually want to give you money and they'll compete for it. So they'll offer you terms like an interest-only period for 2 to 3 years to help you out as you implement your value add plan. But depending on the down payment, you don't want to be too skinny in your equity. So I just had a guy on my podcast a couple of days ago, and right before 2008 happened, he was syndicating these large apartment buildings, but he was leveraging up to 85%. So he grew very fast, but he only had 15% equity in these buildings. So when 2008 hit, and the floor fell out, he found himself in trouble, not because the asset was bad, it's because his debt was bad. He had too much debt on the property. So you want to take that into consideration and just make sure you're, with an apartment building, you definitely want 25%, 30% down. I think, and then you want to stress test your underwriting and how you analyze the deal to make sure you'll be able to cash flow if the market turns.
Okay, so even if let's say you have single family right now, but and you're having trouble to qualify because you already maxed out, will be easier to qualify for multifamily?
Yeah, it's a totally different way the lender looks at your property. So with the residential house, they look at you as a borrower first. So you have to shoulder all of the debt, all of the risk for that loan, and your income is used to qualify it. Once we get into commercial property, the lender looks first at the asset to make sure the asset itself can support the debt. And then they look at you as a borrower to make sure you know what you're doing, the team's in place. So it's the complete reverse of residential financing. So let's say you and I were looking at a 50-unit apartment building. As the lender underwrites the deal, they'll be looking at how strong is the cash flow. What's the value add opportunity? How did this asset perform in the past downturn? They will want to see the vacancy rates and our business plan and what we see in the property. All the lender questions will center around that. And then after they ask all those questions, then they'll look at you and I and say, okay, well, do you have the net worth? And then Victor just had another question I'll get to in a second.
Okay.
And then they'll look at the borrower's net worth and how that factors in. And Victor asked a really good question. So he asked, for commercial properties, don't the banks require a personal guarantee? This gets into recourse and non-recourse debt. So what I mean by recourse and non-recourse, recourse debt is what we're used to with a residential mortgage, which means the bank or the lender has recourse to come after you if you don't pay them back, so that they can come after your house, your boat, your car, everything. They'll come after everything to make themselves whole again. Non-recourse debt comes with these larger commercial properties, and that's where the lender will loan you the money. They will mortgage the property, but in a non-recourse position, which means the bank will seize the property back if you don't pay them, but they can't come after your personal assets. This is a huge advantage as a real estate investor because, most of the time, if we're dealing with single family homes, we put everything on the line to acquire the financing. But as soon as we switch into larger commercial properties and we're able to get non-recourse debt, that's a whole lot of risk that's lifted off of our shoulders. And now the property is at risk of being taken back by the lender, but our personal assets are safe. So that would be a big differentiating factor between residential and a larger commercial debt. I hope that answers your question, Victor.
Okay, and can you explain also commercial mortgage and residential? Does it start at 5 unit or 6 unit, or it depends on?
Yeah, every lender is going to be different. Some lenders will give you commercial debt at 6 units. Some will say 7. It's in and around that area, but every lender looks at it differently. So, but I would say if somebody's looking to get into multifamily, what you'll find is the more units you acquire, the stronger the cash flow is, because the expense ratio per unit goes down significantly. So, let's say somebody's looking for a 10-unit apartment building now. I would suggest that they look for a partner who's also looking for a 10-unit and go out and acquire, let's say, a 25 or a 30-unit together, because that property is going to be a whole lot stronger, and have stronger cash flow and be more stable than a 10-unit on its own. So, and I think that's where commercial real estate offers a big opportunity, because the more units you have, the more cash flow you have, there's more meat on the bone for multiple partners. Because anybody who's investing in the GTA or in Vancouver or other hot markets, whether it's New York, Los Angeles, Seattle, if you're trying to partner on a residential property, there's limited cash flow to begin with. And as soon as you add a second person, it dries up. And so many people are buying these properties in a negatively geared position where they're losing money every month just to carry the property. If you get into the commercial side and get more units, you actually are cash flow positive.
Perfect. And feel free to ask questions as we go.
Yeah, don't let Victor be the only person to ask questions, even though Victor's had some good ones. So keep it coming.
Yeah, and the other thing I wanted to ask you, do you suggest to come up with the down payment, or it's better to get other investor help you to pay for a down payment?
Yeah, that's a good question. I think anybody who is bringing on investors for a property should put their own money into the deal. Number one, if it's a good deal, you want to put your money into it because you want to get all the benefits that come with the deal. But number two, I don't think it sits well with investors if you're asking them to put all their capital in and you're not putting anything on your own. But that being said, it doesn't, if most investors are putting in $100,000 each, you don't have to put in, you can put in 50 grand, as long as it's a decent amount of money, or even $25,000. And depending on the size of the deal and how you structure it, if you're acquiring a property with 3 other people, so you have a 4-person partnership, maybe you're running the deal and somebody else is bringing the capital, somebody found the deal, and somebody's bringing the financing. In that situation, I don't think there's an expectation to put your own money in. But if you're, let's say, syndicating a deal where you're bringing on passive investors that are only going to be bringing their money on the passive side and you're running it, I think there's definitely an expectation to put some skin in the game. But in that case, you're probably getting an acquisition fee of some sort when you acquire the property. So you can even roll that into the property and have that as the money in the deal.
Perfect.
Here's Victor again. Victor's on a roll. Okay, so I purchased 15 units and was required to provide a personal guarantee. I must have missed a step to be. No, okay. So I'm glad you brought this up. So Victor, with the 15 unit property, that's not at the size where a lender will give you non-recourse debt. You're looking at 90, 100 unit plus properties where you get that non-recourse debt. So for a 15 unit, yeah, the lender's going to want that personal guarantee. Because the way the lender looks at the deal, a 15 unit versus like a 100 unit property, it's very different. So they would not have non-recourse debt in that case.
So you suggest to start with 50 units and up?
Well, it goes back to what you want to do. I think I'll go look for 100 next. That's great, Victor. Yeah, maybe we can do a deal together. That's awesome. Yeah, for myself, when I went through the exercise, I realized that I needed to go big because my long-term goal is at that level. So at that level, what I need to do is I need to be able to raise money from passive investors, and I need to put my own money in the deal, but I need to find a good value add opportunity where I can earn that return for investors. It's a different game plan than me saying, okay, well, my long-term goal is to own 4 20-unit properties. Like how I would structure that would be different. I would probably look for a partnership opportunity in that case rather than syndicating. And just the type of debt, what you're able to do changes drastically. So I know people who own a bunch of 30 units, 25 units, and they've built a great portfolio. I also know people who buy only 300 unit properties, and they've also built a great portfolio. It's just a different business plan, and it will lead you down different paths, and there's pros and cons to both sides. So that's why I say, like, before you do anything, know where you want to go, or at least have some idea of where you want to go. Because if my goal is to be retired in 10 years and just live off the cash flow of my portfolio, I'm probably not going to acquire 10-unit apartment buildings. I'm probably going to acquire 100-unit apartment buildings if that's my goal. It all comes down to what you want, and then structure that accordingly.
Okay, and can you explain the difference between syndication and partnership? And
yeah, great question. This is something I do a lot on my YouTube channel.
Yes,
I put videos up, and if anybody's interested, it's youtube.com/Seth Ferguson, and I explain. But I'll give you the crash course right now. So most people, if they're doing residential properties right now, they're with partners. They're doing a partnership structure. So that's where a traditional setup would be, somebody finds the deal and they'll manage it. And then somebody brings the money you need for the renovations, the down payment, and they'll sign for the financing, and they'll split it 50-50. Mm-hmm. That's a partnership. And you don't need 2 people in a partnership. A partnership can be 4 people. It can be 5 people. But the key thing to keep in mind is every single person in that deal is considered to be active. So even though somebody's only bringing their money to the deal, so let's say we need $300,000 to do this deal. If everybody else is running the deal and I'm bringing 300 grand, even though some people would call it passive investing, it's not. You are fully active. So if the deal goes south and something goes wrong, you're on the hook just as much as everybody else. There's no such thing as a passive investing spot in a partnership. When we move to a syndication is a specific structure that's made to do these large deals. Wall Street does one thing really well, and that's raise money and put it to work. And that's where syndication came into play. So a syndication is a group of investors who pool their money together, and then they place that money with somebody called a general partner. So we have the limited partners, who are the passive investors bringing their money. And then we have the general partners, or the active partners. They're the people with the real estate experience, and they run the deal and they make all the decisions. So as opposed to a partnership where everybody is active under the eyes of the law, in a partnership, the limited partners are limited in their risk and their liability. For instance, if we buy a stock or if we invest in a mutual fund, or if we buy a house, we're risking our investment, we're risking our capital. That doesn't change. But where it does change is with the syndication. Let's say worst case scenario happens and the deal falls apart. The lenders and everybody who is hurt from that deal will go after the general partners. They can't go after the limited partners. So it's true passive investing. So in the syndication, the investor is bringing their money, and that's going to be managed by the general partners, but they don't make any decisions about the property. They're trusting the general partner who has the experience, the track record, the team, the deal flow, the broker relationships, and the market knowledge. So syndication allows for people who are already busy working full-time jobs, who don't have the market knowledge, who don't have the expertise running apartment deals, to actually invest in these opportunities and get all the cash flow, the tax benefits, everything else that comes along with apartment buildings. But all they have to do is bring their money, and then the general partnership takes it and puts it to work. So it's a great opportunity for somebody who's like, we have doctors, we have lawyers, accountants, programmers, business owners who are working like 60 hours a week, who don't have time to run another full-time job and start a real estate company from scratch.
And let's say somebody wants to have, somebody's in waiting room. Somebody, you wants to maybe retire in 5 years, not 10, 5.
Yeah.
Let's say you want to start with 10,000 a month as a cash flow. Will you suggest to manage, like to buy maybe 20, 25 unit, or I don't know, 30, and manage it yourself, or it's better to find a management company?
Well, I think it kind of goes down to what you want, because, one thing I found out when I was doing my single families is I hate managing properties.
Yeah.
I don't know any investor who likes getting the phone calls at night. So
yeah.
Just from that perspective, I would say, having a manager running the property, you're probably going to have a better run property. Because we're people, we're human, and if we don't enjoy something, chances are we'll find something else to do. But it all comes, like, if somebody finding a good property is tough, it is 100%, Victor. And you also want to find a property manager who's experienced in the asset. So for instance, if I have a Class B 30 unit property, I'm not going to hire a property manager who only does 75 units and above that specializes in Class C property. That's not a good fit. Or, if you're just getting into some multifamilies and like the 15 unit property you just bought, Victor, you're not going to hire a single family home property management company to run that, because it's a different type of asset. So there's lots of things to consider when you're looking for property management. And, through my podcast, I get to hear all these stories from people who've learned tough lessons by making those wrong mistakes.
What are the most common mistakes a beginner make when they start investing in a multifamily?
Yeah, I think the big one is not underwriting the property sufficiently well. And what I mean by underwriting is by analyzing the property in your game plan. So what will happen is, let's say somebody's buying a property in the current market environment. So the market's really hot right now, whether it's on the residential or commercial side. Mm-hmm. What will happen is, let's say you're competing against 4 other offers. It's very easy for a beginner to start changing numbers on their spreadsheet to make it work on paper, in their Excel document. It's a big difference going from an Excel document where you just change the numbers to actually making it happen in real life. So I would say that's a beginner mistake. They get caught up in the excitement and they start offering more than what their underwriting is telling them to. And what happens is, let's say there's a market correction, cap rates increase. So that means the property values go down. You have more vacancy. Less people are paying the rent, so your collections go down. You have to offer more incentives and concessions to bring tenants in. You can find yourself in trouble because you didn't account for all those things in your underwriting because you overbid and you just changed around your spreadsheet. So just be very prudent and think about the worst case scenario, because you're going to be holding the property most likely through good markets and bad markets. And, and if you're just getting started in real estate, you might not have experienced a bad market before. So go out and talk with people who have a couple more gray hairs and learn from those people, because how you manage your property. Yes, that's what I did. Excellent, Victor. Because how you manage your property and the problems you will face will be different. And that's why having a good experienced property manager, and lots of management companies now will actually walk through the property with you, especially for really big properties, but they'll actually come with you, walk through the property with you as you're looking at it, and they'll be able to see things and opportunities that you won't see, especially if they're really familiar with the market and the asset class. And they'll be able to guide you and give you some tips and advice to help you make the right decision in terms of, how hard you can push rents, or where's the upside. What additional income streams can you put into the property? A good property management company, just like what Victor was saying, finding a good one is tough, but once you do find one, they are well worth it.
Perfect. And oh God, what was the question I was going to ask you?
Oh, that's okay. We'll make one up.
Can you give us an example, like what to consider when you're doing underwriting? What absolutely you can't forget?
Yeah. So let's say we're acquiring, I don't know, 50 unit apartment building. Let's make it up.
Yeah.
And it needs some renovations, right? So what lots of people forget, if it's their first deal, is they'll look at the rents coming in now with the building, and they'll look at the rents after you renovate it and how much you can increase it. But what they forget is, well, if you're renovating the unit, it's probably going to be offline for 3 months, and lots of people will forget to factor that in. So what happens is they start doing the renovations, and all of a sudden their cash flow dries up, and they don't know why, because their spreadsheet makes sense. Well, it's because nobody's paying rent for 3 months in that unit. And if you're doing with 50 units, if you're renovating 30 of those 50, that's a significant amount of rent that was supposed to be there, but it's not anymore. Other things to keep in mind, if you're buying a property with a bridge loan, so like a short-term debt, so a bridge loan could be 1 or 2 years. If you're going in to fix it up, and then you're going to get a more conventional type of debt on the property for longer term hold. What happens if the market tanks right when you have to move from your bridge debt to your conventional debt? A lot of people don't think about that. And I actually just recorded a video for the YouTube channel today about this. So always think of the worst case scenario happening as soon as you need something. So if you're planning on refinancing the property after you do all the work and bring up the rents, well, in your underwriting model, work in the market crashing as soon as you want to refi, because that will force you to think about the worst case scenario and what you can do and have other options. Because so many times, people will assume the market's going to be as good as it is now. The other thing would be, when you're planning on selling, so maybe you're selling in year 7 or year 5 or year 6, always assume the market's going to be softer. So if you bought at a 4.5 cap, assume the market's going to be selling at a 5 cap. And so if somebody's not familiar with cap rates, the lower the cap rate, the more somebody is willing to pay for every dollar of net operating income the property produces. So as cap rates go down, the property value goes up. So when I say the market softens, so if you bought it in a 4.5 cap rate, the market softening would mean the cap rate goes up. So each dollar the property produces will be worth less at a 5 cap. So always assume somebody's going to pay less for each dollar produced when you sell. So those are just a couple things that I see most often. It's just people not being conservative and not thinking of the worst case scenario. And the way you get that is, you talk to somebody who's familiar with the market, who's been through multiple market cycles, talk to your property manager, and then, oh, Victor's on fire here. Most multi-units are older. Do you tend to avoid if it passes a certain age? How long do you hold it before you sell? Really good questions. So what you'll find, Victor, is with these larger syndications, generally speaking, will sell between year 5 and year 10. The reason we do that is we look at not only return on investment, but return on equity. So oftentimes with these larger deals, especially in the US, we have tax credits that we can take advantage of through depreciation, and these tax credits run out. So it makes more sense to sell, get into a new property, and then start the cycle all over again. If you're buying on your own and your goal is to own these long-term and just continue to refinance, you may hold on to them indefinitely. It just depends. But for these larger deals syndicating, it often makes more sense to sell after, after year 5 for sure, because the tax credits run out. In terms of your question about age, there's pros and cons to every class of property. So, a class A property would be something that's, brand new, relatively new. You're going to get a rent premium, but you're going to pay for it. So your cash flow is going to be less on the property, but is your appreciation going to be more? Some people would argue yes. With a class B, which is my preference, you're 20 years old, so we might be dealing with a 2000 build, 2004 build. I'll get Ling, I'll get to your question next. I think that a class B is a good balance between having the newness of the property and then also having cash flow. And then a class C property is going to be older. It will have deferred maintenance. You do tend to have higher tenant turnover, but your cash flow is a lot stronger. And I think you as an investor have to ask yourself where you see your skill set being most advantageous. I know people who've done very well investing in older properties. They have higher cash flow. They know how to deal with the higher turnover rates. They've built a good business. But I also know people who buy core type of properties in downtown areas that are basically brand new, and they just sit on them for 10 years and they've done well as well. So I think it goes back to what you want to do. If you want to deal with tenants moving out on you all the time, if you're okay with that, but getting higher cash flow, go for an older building because that's what it's going to give you. Ling asked, 3 most important reasons to invest in multi-units properties over residential properties. Ooh, that's another good question. You know what? I have to commend you, Fanny. Everybody has good questions today. So you've got a good group of people. All right. So 3 most important reasons to invest in multi-unit properties. Number 1 is cash flow. Without cash flow, your deal dies. I went through the low yield with my single families, and then I realized I needed to move into multifamily. So cash flow. The second thing would be scalability. It is far easier to scale a portfolio of multifamily property than it is single family homes. I lived through that as well. It just frees up so many more options as you get into multifamily property. And then third, I would say the structuring aspect of it, you're able to more efficiently bring in other investors into the deal with you through the syndication structure or a fund structure, even a partnership. There's more meat on the bone, and that makes it easier to bring on partners. So, for instance, with a single family home, as an investor, we have to wear our real estate agent hat. We have to wear our financing hat, our contractor hat, our property manager hat, all the different hats. Most people do it on their own. If you're buying a larger multifamily property, you have one person whose only job it is to manage the property. That's their job. So you're able to bring on a true expert. If you have renovations, you bring on somebody whose only job is to oversee the renovations and the construction. That's what they do. Then you have somebody to raise the capital. That's all they do. So instead of wearing multiple hats, you're able to focus people's skills on what they do the best. And I would argue that the deal and the property and the investors are better served when you have people laser focused rather than trying to be a jack of all trades, master of none. Good, great question.
Okay, what's the cap rate we should be looking at to make sure it's a good deal?
Yeah, I'll answer the cap rate, and then Ling had another question. So cap rates don't matter. Lots of people like to talk about cap rates, but it's important to realize that in the grand scheme of things, it's not the cap rate that drives the investment. It is the value add play and what you can do with the property. So for instance, let's say we are acquiring a property and it's the rents are under market value, it needs some renovations, and we're able to add like a self-storage component and charge people extra rent for covered parking, some extra storage facilities, all of that stuff. So we're able to bring in extra revenue. And then maybe let's say the utilities now are being covered by the landlord, and then we can now switch it over to the tenants. So that's our business plan. Whether we acquire that property at a 4 cap or a 5 cap or a 6 cap is irrelevant. What matters is where the market is now and how we can bring that property up to market value. It doesn't matter if it's a 4 cap or a 4.5. What we have to take into consideration is where the market's going and how the market performed in the last downturn, so we know what to expect when the market does go into its slump phase. But the issue I have with people saying, "Oh, well, I don't buy properties unless it's over a 5 cap." Well, that's just an arbitrary decision that has nothing to do with the actual investment opportunity. Like I know people investing in New York City in multifamily, buying properties at like a 2 something cap, and they are making money because their business plan allows them to do that. They don't care about the cap rate. They're looking for the upside and what they can control in the property to force that appreciation and manufacture their equity. So that's what I would say to that. And then I'll just get to Ling's question. How do you structure your loans for multi-unit properties? Ling, can you just specify what you mean by how you structure your loans? Like, are you talking about the capital stack? I'm just not sure what you mean.
You can unmute yourself and ask your question.
And then your 3 most painful lessons to learn from your investments. Okay, so I'll start answering question 3 if you can just clarify question 2. Most successful tips. So number 1, I've said this multiple times, know where you want to go before you start investing. Because if I could go back in time, I would have chosen a totally different path and I would be 10 years ahead if I would have done that. So know where you want to go and structure and make decisions accordingly. Number 2, I would say, is don't be afraid to partner with other people. When I started first investing, I thought you had to do everything on your own. It was better. As you get into larger properties, you'll actually realize that other people are an asset. They bring different strengths than you do. They're able to bring different opportunities. And as you get into these larger properties, having a team is what counts. A lender will look at your team. If you're trying to acquire a 70-unit property on your own, you can, but you'll make a much stronger case with a lender if you have a team of experts behind you. So don't be afraid to partner up. That would be number 2. And then the third successful tip I would say is don't be afraid to raise money from other investors. There is a lot of capital out there that is looking for a good deal. And this is something I was totally oblivious to when I was doing my single family homes, because I was, you're doing the debt, you're refinancing, using the proceeds to buy the next property. I had no idea the amount of money sitting out there that people want to put into deals. They're just looking for the right opportunity. So don't be afraid of talking about what you're doing, the opportunities you have, and what you're doing in real estate, because chances are you'll come across somebody who doesn't have the expertise, who doesn't have the knowledge, the time, but they have the money. and you can put that to work. And then painful lessons. I think my most painful lesson was losing my single family portfolio. So what happened at the time was my my partner at the time and we acquired these single family properties, and she ended up wiping out the bank accounts, taking all the money, refusing to lease the property, and so very quickly it turned into a really bad situation because we started having vacancies. The money was gone from the bank accounts. We had these mortgages coming in. She wouldn't put tenants in the properties anymore. So very quickly it spiraled into a pretty bad situation. So the lesson I learned from that is, if you are going to enter into a partnership in real estate, make sure you have a very clear partnership agreement in writing that lays out, if something happens, what will then happen. So if one person stops, if one person stops replying to emails and something happens, what will happen at that point? Are you able to shotgun somebody out of the partnership if certain criteria are met? And if so, how is the portfolio valued? How will you buy them out? Always think about the worst case scenario. I did not do that. I got burned and I lost a lot of money. So that would be my most painful lesson for sure. Oh, just both or out of the box arrangements. Oh, okay. So that is a good question. I think it all depends, Ling, on the size of property you're looking at. If you're going for like 100 unit or a 75 unit or a 50 unit, chances are lender's going to be pretty competitive and want to give you the debt on the property, like a conventional mortgage. If you're doing some smaller properties that need a heavier lift, you can definitely explore creative loan arrangements. Maybe a vendor take back mortgage or seller financing for a portion of it. One thing that's very common in the commercial space is assuming debt. This used to be common in residential mortgages 20, 30 years ago. It's not anymore. So what will happen is, if a seller has a mortgage with 3 years remaining on their term, the new buyer is able to assume it, which has the advantage of being longer, much farther along its payment cycle, so more payments going towards the principal. So you can assume that and then get another mortgage, which is called a pari passu mortgage, where the two mortgages are on the same level. There's not a first and second mortgage. That happens in the commercial space. So you tend to have more options on the commercial side, and things are a little bit more flexible. But yeah, like if you're going for a smaller multifamily property, seller financing is one. There's some options for you. So I hope that answers that question. Oh, do you use mortgage for? Yeah. So again, it depends on the property. There are a number of mortgage brokers out there who specialize in multifamily property. So you definitely want to use them. A lot of large brokerages now have a mortgage arm. Whether or not you want to use the brokerage house you're buying from to do the financing, that's up to you. Yeah, and then also you can go directly to the lender, which is, as you get into the larger properties, that's what you usually end up doing. You'll go directly to the, oh, thanks for subscribing, Victor. I appreciate it. So yeah, like it goes back linked to the size of the property, but yeah, a mortgage broker will definitely be able to steer you in the right direction. But just make sure you're working with somebody who understands commercial property and the multifamily space, especially. If somebody's only comfortable doing residential mortgages and they say they can help you out doing multifamily, that's probably not the best relationship for you, because you need somebody who knows what they're doing.
Is any lender you suggest, or it doesn't matter?
It depends on the country you're in. So, in the States, you've got Fannie, Freddie. There's a whole bunch of lenders you can choose from. Here in Canada, all the major banks are very heavy in commercial, First National, RBC, TD. And then plus, we have, you can have CMHC insured mortgages. I think, are most people here in Canada on the call?
I think so.
Yeah. So on the Canadian side, just like CMHC insures residential mortgages, they do the same thing with multifamily. So your cost of the debt significantly goes down, and it can be quite advantageous to get a CMHC insured loan for your multifamily property. Oh, Dre has one. Hello, Seth. How do you deal with difficult tenants? How do you screen new tenants? Can you share some of your experiences dealing with tenants? Oh, Sandra's in California. All right. Montreal. Oh, excellent. Okay, so how do you deal with difficult tenants? How do you screen new tenants? Well, that goes back to where you are, because as we know, different provinces and states have different landlord-tenant laws. In Ontario and California, it's very pro-tenant. If you're in a place like Alberta or Texas, the landlord has more control. So how you can evict somebody and move them on will change. I think if you're acquiring a property where you do have a problem tenant profile and you're looking to change that, just by being on top of things. So making sure you're submitting your notices for late payment, even if it's 1 day late, send it in. Tenants will very quickly get the hint that somebody is new in town and they mean business. So just being on top of your paperwork, especially if the former owner was maybe a little bit more lax, that would be one suggestion. And screening new tenants. If you're running if you have a property management company, they'll be screening and doing all that stuff for you, which I do suggest. But looking at their credit reports, looking at the credit bureau, looking at payment histories, obviously looking at their social media profiles. If somebody's saying they don't have dogs and then on Facebook they've got 3 huge dogs in their picture, that's definitely a red flag. So all those things. But I would suggest though, like if you have property management, rely on them. Just make sure, as Victor said before, you have somebody good working with you.
Okay. How do you know it's a good deal? What to look for to make sure it's a good deal?
Good deal. Well, a good deal can come in many different forms. So my preference is a value add strategy where we're acquiring a property that is underperforming the market for whatever reason, whether it's under market rents, whether it's poor management, whether it's expenses are out of line. The reason I like value add is we are able to control what we do to the property to bring its value up. And that's the other advantage with commercial real estate, because it's valued based on the income it produces, not necessarily on comparables. So what makes a good deal? Well, it would be acquiring a property with that value add play where I can hit the return targets I've set for myself. One person's good deal might not be a good deal to somebody else. The deals I'm looking at, we want them to pencil out between 15 and 17% annualized over the hold period. That's what we're looking for. So, but maybe somebody wants, their criteria is 10%. So a deal that I would pass on, they might go for. Some people choose to do more of a core strategy where they just buy in a major metro center without a value add play, and they're just holding it for the long term, hoping for that long-term appreciation and market growth. A good deal for that person, I may pass on it because I don't see the forced appreciation aspect of it. So again, it all depends on where you want to go and what fits with your lifestyle.
And so what does financial freedom means to you?
What does it mean? Well, I think financial freedom, it gets tossed around a lot. When we say financial freedom, I really think that most people are really talking about time freedom, because, you and I, we have a finite amount of time. We all have 24 hours in a day. At some point we will all die. We can't control it. Financial freedom means us being able to have choice over what we do with our time. I think that's really what it means. You can have all the money. You can talk about, oh, I have money, but what does the money give you? Well, it gives you options for what you do with your time. So that's why I say time freedom, not financial freedom.
It makes sense because you want to spend time with your loved one and you want to do what you want. So that's why we do what we do because we want to not to exchange our time.
Victor's got one. So what tips do you have to get investors to invest in you to get a deal done? Yeah, so that's a totally different topic, Victor. We could run like a full week course on that. I think just very briefly, you have to demonstrate your expertise. You have to demonstrate alignment with what their interests are, and then you also have to have a deal that has a little bit of sizzle. We are selling, so your deal has to have an attractive component to it. And you have to position the deal so it is attractive to investors. But yeah, just you need to make sure the investor is comfortable in your team, your strategy, and have a little bit of sizzle on the opportunity.
Can you put on your chat your YouTube channel so people can?
Oh, sure. Okay, youtube.com/Seth Ferguson. And then Ling had a question here. If you win the Lotto Max and never have to worry about money, what will you do next with your life? Probably keep buying apartments. The reason is, I want to be able to leave a portfolio for my son. So everything I do centers around that. I'm a huge history nerd, so I would just love to do history stuff all day. But I will also put a link in the chat to a Facebook group we have. We just started it up. So by all means, join there. We've got a great group of people so far. And then if you don't, what do you prefer? 1 bedroom, 2 bedroom? Again, Victor, it depends. Some people would argue that 2 bedrooms are more stable and downturns because people can get roommates. With 1 bedrooms, you have a different type of tenant, usually single people who tend to move a lot more. With 2 bedrooms, may end up with more families, and then also you have the roommate. So I'm just looking for a mix. Usually, we're looking for 40 to 50% 2 bedroom. If there's a 3 bedroom, you're just looking for a decent mix of 1, 2s, and 3s. And then, what was there? Oh yeah. So if anybody's interested in learning more about multifamily real estate, join the Facebook group, check me out on YouTube. But we also have a really cool event coming up next year, May 14th and 15th, 2022. We have Kevin O'Leary coming in for the Multifamily Conference. So this is going to be in Toronto. We've got Kevin O'Leary, we've got Rod Cleef, who's a big multifamily guy. We have Richard Wilson, who's his big thing is capital raising. He's a capital raising expert. We've got Mike Reed. We have Edna Keep, who grew a huge portfolio with her and her husband. She's from out west. She's coming in to speak. Who else do we have? Joel Block. So for structuring and how to structure your investment, Joel Block is the king. So we actually have a special discount code for all the Green Mine listeners. So if you go to multifamilyconference.ca, I'll put it in the chat.
Yes, please. Yeah.
Multifamilyconference.ca. When you buy your ticket, use the code GreenMine.
Yes, GreenMine. Yeah.
And then you'll be able to save 10% off your ticket. This is something special we're doing for everybody here. But I am so excited, and it's not a virtual conference. Next year, we're back in person. Say goodbye to Zoom. And I'm so thrilled with the speaker lineup. And we've got people that we haven't announced yet, so it's still a secret. So
perfect.
Yeah.
And what would you suggest for somebody who wants to jump in multifamily? Is it better to go just residential or mixed unit, like commercial? Business.
Yeah, it really depends. How lenders are looking at those properties is different. Especially, over the past year and a half with coronavirus. Lenders were a little bit more gun shy with the commercial component because, we had lots of issues with businesses who got shut down. Pure multifamily has been more stable, so you don't have to worry about longer vacancy periods in the commercial space and the economic viability of those businesses. I don't do mixed use, but I know people who do. So it kind of depends on what you want to do.
I guess for if you're starting out, it's better just to stay with residential.
Yeah, it all depends on if you feel that it's better for you and that's going to take you closer to where you want to be, go for it.
Perfect. Okay, guys, don't forget to subscribe on his YouTube channel, and if you buy the ticket, so you get 10% off.
Yeah, I'm so excited about the conference.
Yeah,
So it'll be really fun.
Me too. Yeah, hopefully COVID will be done.
Oh, we are, yeah. And, in the event that, Corona is still around, we do have plan Bs in terms of, like, the venue's very big, so we're able to accommodate all the distancing, but our hope is that we're back to normal in May next year.
Yeah. So, any more question? Guess, yeah, Link has one more question.
Oh, besides property investment, what other investments on your? I do some stock options, so that's what I'm doing as well. But the long-term wealth building strategy is real estate, and I think the past couple hundred years has proven that for sure.
All right, Seth, I want to thank you so much for your time and for accepting to come to talk to us. I really appreciate. Thank you so much. And I look forward to this event next year.
Yeah, thanks for having me. You had a great group of people who asked some really good questions. So was really glad to come out and hang out with you guys.
Thank you so much. Everybody have a wonderful evening and go make money. Go buy a multifamily. All right. Thank you, everybody, and have a wonderful evening.